A leaked internal report from Bank of America just crossed my desk, and what it says about gold is absolutely stunning. We're not talking about the carefully worded public research they publish for retail clients. This is an internal memo meant only for their wealthiest private banking clients, and the price target they're discussing is so explosive that if it gets out publicly, it could trigger a gold rush like we haven't seen in decades. $5,000 per ounce. That's not a typo. Bank of America's private wealth division is telling their ultra-high net worth clients to prepare for gold at $5,000, and the timeline they're projecting is shockingly soon. If you're not positioned in gold right now, what I'm about to reveal could be the wake-up call that changes your financial future forever. Welcome to George Vance Live, where we expose the intelligence that the financial elite keep hidden from ordinary investors. If this is your first time here, you need to subscribe immediately and hit that notification bell, because the information in this leaked report is so valuable that major institutions would pay thousands of dollars to access it, and I'm giving it to you right now for free. Let me start by explaining exactly what this document is and how I obtained it, because credibility matters. This is a 23-page research memo dated February 2026 from Bank of America's private bank division, specifically their commodity strategy group that advises clients with at least $10 million in investable assets. These are not public-facing analysts writing research to generate trading commissions. These are the strategists who manage money for billionaires, family offices, and sovereign wealth funds. When they put out research, it's because they're actually positioning real money based on their analysis. The report was leaked to me by a source within the private banking division who was alarmed that this information was being kept from the general public, while wealthy clients were being advised to make massive allocations to gold. The memo outlines a base case scenario where gold reaches $3,800 per ounce by the end of 2026, and a bull case scenario where gold hits $5,000 per ounce by mid-2027. To put that in perspective, gold is currently trading around $2,100. The base case represents an 80% gain. The bull case represents a 138% gain. These are not normal price targets for a major bank to be discussing internally. Now let me walk you through the key sections of this report and the analysis that led them to these explosive conclusions, because the logic is absolutely compelling. The first section is titled Sovereign Debt Crisis and the End of Dollar Hegemony, and it lays out the most detailed analysis I've ever seen from a major bank about the coming collapse of confidence in fiat currencies. They start by pointing out that global sovereign debt has now exceeded $100 trillion and is growing exponentially. The United States alone has $35 trillion in federal debt with trillion-dollar deficits, projected as far as the eye can see. The report states, and I'm quoting directly, "The mathematics of debt service at current and projected interest rates makes it impossible for developed nations to grow their way out of this crisis. The only viable options are default, which is politically unacceptable, or inflation, which is politically expedient. Central banks will choose inflation, and gold is the only asset that preserves purchasing power when all major fiat currencies are being deliberately debased simultaneously." This is a major bank explicitly telling their wealthy clients that governments are going to print money and destroy currency values, and gold is the escape route. The second section analyzes central bank gold buying, and this is where it gets really interesting. The report points out that central banks globally purchased over 1,100 tons of gold in 2024, the second highest annual total on record. But more importantly, the identity of the buyers has changed. It's no longer just emerging market central banks diversifying reserves. Now you're seeing European central banks that previously sold gold starting to buy again. The report specifically mentions that Poland, Czech Republic, and Serbia have been aggressive accumulators, and there are indications that even larger European banks are preparing to increase gold reserves. China is highlighted as the most significant buyer, although the report notes that China's official reported purchases are certainly understating their true accumulation. The analysts estimate that China is buying between 100 and 200 tons more per year than they officially report. Why? Because they don't want to drive the price up before they've accumulated their target allocation. The report states that China's long-term goal is to have gold represent at least 10% of their total reserves, up from the current, officially reported 4%. To get to 10%, they need to buy approximately 5,000 more tons. At current production rates, that's several years of buying pressure that will underpin prices regardless of other market dynamics. The third section is titled De-dollarization and Alternative Reserve Assets, and this is the most explosive part of the memo. Bank of America's strategists lay out evidence that the dollar's role as the world's reserve currency is being actively undermined by coordinated efforts from China, Russia, and increasingly other nations. They point to the expansion of BRICS, which now includes Saudi Arabia, UAE, Iran, Egypt, and Ethiopia, in addition to the original Brazil, Russia, India, China, and South Africa. These countries represent over 45% of global population and over 35% of global GDP. The report discusses the development of alternative payment systems like China's CIPS that bypass the dollar-dominated SWIFT system. It mentions bilateral trade agreements where countries are settling in yuan, rubles, or their own currencies instead of dollars. Most significantly, it discusses the potential for a BRICS currency backed partially by gold that could be launched as soon as late 2026. The analysts write, if a gold-backed BRICS currency is launched with even partial adoption for international trade, it would represent the first viable alternative to the dollar system since Bretton Woods. The implications for gold demand would be extraordinary, potentially requiring thousands of tons of gold to back the currency credibly. This alone could drive gold to $4,000 plus in a short time frame. Think about what they're saying. If BRICS nations, representing nearly half the world's population, create a currency backed by gold to compete with the dollar, every country in the world would want to hold some of that currency in their reserves, but to get that currency, they'd need to have gold to exchange for it or to provide backing. The scramble for gold would be unprecedented. Bank of America is telling their wealthiest clients this is not just possible, but probable within the next 18 months. The fourth section analyzes inflation and real interest rates, and here's where the math gets really compelling. The report points out that official inflation numbers significantly understate true price increases in essential goods and services. They calculate that real inflation is running between 6 and 8% when measured properly, while bond yields are around 4 to 4.5%. This means real interest rates, the return after inflation, are deeply negative. In an environment of negative real rates, gold historically outperforms because the opportunity cost of holding it versus bonds is minimal, while gold preserves purchasing power. The analysts project that central banks are trapped. If they raise rates high enough to truly combat inflation, they'll crush the economy and cause a debt crisis because governments can't afford the interest payments. If they keep rates low, inflation persists and currencies lose value. They've chosen the second path, which means negative real rates are here to stay for years. The report explicitly states, in a world of persistent negative real interest rates and currency debasement, gold's fair value is substantially higher than current prices. We calculate that gold should trade between $3,500 and $4,500 per ounce just to maintain its historical purchasing power relative to the expanded money supply. Section 5 examines geopolitical instability and safe haven demand. The report catalogs the unprecedented number of potential flashpoints around the world, the ongoing Russia-Ukraine conflict, rising tensions between the US and China over Taiwan, instability in the Middle East with Iran, Israel, and various proxy conflicts, North Korea's nuclear program, the fragmentation of the European Union under economic stress, political polarization, and potential civil unrest in the United States. They argue that this level of simultaneous global instability hasn't existed since the 1930s and 1940s, and during those periods, gold was the ultimate safe haven. The memo states, our geopolitical risk models indicate a higher than 60% probability of at least one major conflict involving great powers within the next 24 months. History shows that gold appreciation accelerates dramatically when geopolitical risks escalate from theoretical to actual. Clients should be positioned in gold before the next major crisis, not after. This is Bank of America telling billionaires to buy gold now because they see a greater than 60% chance of a major war in the next 2 years. Let that sink in. Section 6 discusses mining supply constraints, and this is important because it addresses whether increased supply could satisfy the demand they're projecting. The short answer is no. Global gold mine production has been essentially flat at around 3,500 tons per year for the past decade despite rising prices. Why? Because the easy deposits have been mined. Environmental regulations make new mines difficult to permit and develop, and the discovery rate of new economic gold deposits has declined significantly. It takes 10 to 15 years on average from discovery to production for a new gold mine. The report points out that even if gold prices double, you won't see a significant supply response for years because the projects don't exist to be developed. Meanwhile, demand from central banks, institutional investors, and retail buyers in India and China is structural and growing. The analysts calculate that if just 5% of global financial assets shifted into gold as a portfolio allocation, it would represent demand for over 30,000 tons, which is nearly 10 years of current mining production. The price would have to rise dramatically to balance that demand against the inelastic supply. Now here's where the report gets into specific recommendations, and this is the section that really drives home why it was kept internal. They recommend that clients allocate between 15 and 25% of liquid assets to gold exposure immediately, with the higher end for more risk-tolerant clients. That's an enormous allocation by traditional portfolio construction standards, which typically recommend 5 to 10% at most. They're telling billionaires to put up to a quarter of their money into gold. That's not a hedge. That's a core conviction position. The memo breaks down how to implement that allocation. They recommend 40% in physical gold, specifically large bars held in allocated storage in Switzerland or Singapore, not in US or European vaults. They recommend 35% in high-quality gold mining stocks, specifically naming companies like Newmont, Barrick Gold, Agnico Eagle, and Franco-Nevada. They recommend 15% in gold ETFs like GLD or IAU for liquidity. And they recommend 10% in gold option strategies for clients who can afford speculative risk. Think about what that allocation tells you. They're recommending physical gold stored outside Western jurisdictions, which suggests they're concerned about potential capital controls or confiscation in a crisis. They're emphasizing mining stocks for leverage to the gold price move. They're keeping some in liquid ETFs for tactical trading. And they're using options to amplify gains for the portion of the portfolio that can afford high risk. This is a very sophisticated, conviction-based approach, not a casual diversification recommendation. The timeline they provide is also specific and near term. They expect gold to break through $2,500 by mid-2026, reach $3,000 by late 2026, and potentially hit $3,800 to $5,000 by mid-2027 if their bull case scenario plays out. That's 12 to 18 months for a potential doubling in price. They note several specific catalysts that could accelerate the timeline. A major central bank announcing a significant increase in gold reserves, the actual launch of a BRICS currency, a debt crisis in a major developed economy, a major geopolitical event like a Taiwan invasion or Middle East war. Any of these could act as a trigger that brings forward the price appreciation they're expecting. Let me now tell you what this means for you and how you should be positioning based on this intelligence. First, understand that when Bank of America tells their billionaire clients to allocate 15 to 25% to gold, that's based on rigorous analysis and represents real money being deployed. These aren't talking heads on financial TV throwing out opinions. This is the bank that manages money for some of the wealthiest people on the planet, giving specific allocation guidance. You should take it seriously. Second, recognize that you have an advantage right now that you won't have for long. This report was meant to be private. The general public doesn't know that major banks are projecting $5,000 gold. When this information spreads, and it will, you'll see a rush into gold that drives up prices and premiums. You're getting this intelligence before the crowd. Use that advantage. The time to position is now, before CNBC is running segments on gold surge, and everyone is chasing it higher. Third, you need to structure your gold exposure appropriately based on your situation. If you're conservative and prioritizing wealth preservation, physical gold should be your primary focus. Buy coins like American Gold Eagles or Canadian Gold Maple Leafs or bars from reputable refiners. Store them securely, either in a home safe or in allocated storage at a facility like Brinks or a private vault. The advantage is complete ownership with no counterparty risk. The disadvantage is you pay premiums and storage costs and there's no leverage. If you want growth and are willing to take on more risk, gold mining stocks offer leverage to the gold price. When gold goes from $2,100 to $4,000, a mining company producing gold at $1,200 per ounce sees their profit margin more than double. That flows through to stock prices. Quality miners like Newmont Mining, Barrick Gold, Agnico Eagle Mines, or Kinross Gold could easily see their stocks double or triple if gold hits the targets in this report. Royal Gold and Franco-Nevada are royalty companies that provide even more leverage with less operational risk. For maximum leverage with maximum risk, junior miners and exploration companies can deliver explosive returns but also go to zero if they fail. Companies like B2 Gold, Endeavor Mining, or smaller explorers can multiply by 5 to 10 times in a gold bull market. But you need to do your research and diversify across several names because individual company risk is high. Only allocate money to juniors that you can afford to lose entirely. Gold ETFs like GLD or IAU provide convenient exposure and liquidity. You can buy and sell them instantly in your brokerage account. However, there are questions about whether these ETFs actually hold all the physical gold they claim. And in an extreme crisis, there's uncertainty about redemption. They're fine for the portion of your allocation you want to trade actively, but I wouldn't put everything in ETFs. Physical gold you hold yourself is more secure for your core position. For sophisticated investors who understand options, buying call options on GLD or on mining stocks provides enormous leverage. If you buy call options with a $2,500 strike price on GLD, expiring in December 2026, when gold runs to $4,000, those options could be worth 10 to 20 times what you paid. But they can also expire worthless if the move doesn't happen or takes longer than expected. Only use options with money you can afford to lose, and only if you truly understand how they work. Here's how I'd structure a gold allocation based on this Bank of America intelligence. If you're allocating 15% of your portfolio to gold, I'd put 50% in physical gold coins or bars for the foundation. I'd put 35% in a diversified basket of major gold mining stocks for leverage. I'd put 10% in gold ETFs for liquidity and trading. I'd put 5% in call options or junior miners for maximum upside potential, with the understanding that this portion could go to zero. This gives you balanced exposure across the risk spectrum. Now let me address the obvious question. Could Bank of America be wrong? Of course they could. No one can predict the future with certainty. But here's what gives me confidence in this analysis. First, these are the people who manage money for billionaires. Their track record and their clients' wealth depend on them being right. They're not incentivized to make wild predictions. Second, the analysis is rigorous and well supported. Every claim in the report is backed by data and logical reasoning. Third, they're putting real money behind this. This isn't a hypothetical research paper. They're allocating billions of dollars of client money based on these projections. Fourth, the fundamental case for gold is stronger than it's been in decades. Massive debt, currency debasement, geopolitical instability, central bank buying, supply constraints, all of these are objectively true regardless of what happens to the price. Fifth, other smart money is positioned the same way. If you look at what Ray Dalio, Stanley Druckenmiller, Paul Tudor Jones, and other legendary investors are saying publicly, they're all bullish on gold for similar reasons. When the smartest money in the world is aligned, you should pay attention. The risks to this thesis are primarily around timing and government intervention. Maybe the move to $5,000 gold happens, but takes 5 years instead of 18 months. Maybe governments implement capital controls or windfall profits taxes on gold that limit gains. Maybe they change the rules in ways we can't foresee. These are reasons to be thoughtful about position sizing and risk management, but they're not reasons to ignore the opportunity entirely. Even if gold only goes to $3,000 instead of $5,000, that's still a 43% gain from current levels, which is excellent for a hard asset. Let me share some additional intelligence from the report that I haven't covered yet. There's a section on retail versus institutional positioning that's fascinating. The analysts note that retail investment demand for gold has been relatively muted despite higher prices. ETF holdings have been flat to declining. Coin sales are solid but not spectacular. Retail investors are still primarily focused on stocks and cryptocurrency. Meanwhile, institutional and central bank buying has been relentless. This divergence suggests that when retail finally catches on and starts buying, there will be a significant surge in demand that current prices don't reflect. The report also discusses the gold to silver ratio, noting that silver typically follows gold higher but with more volatility. They suggest that if gold reaches $5,000, silver could hit $75 to $100 per ounce, which would be a triple from current levels around $25. They recommend a 70% gold, 30% silver split for clients who want precious metals exposure, with the silver portion providing more upside but also more risk. This aligns with the historical gold to silver ratio reverting from current levels around 90 to 1 down to 50 or 60 to 1. There's also analysis of potential government responses to rising gold prices. The report acknowledges that if gold surges to $5,000, governments may implement measures to limit capital flight from their currencies into gold. This could include higher taxes on gold sales, restrictions on gold ownership, or even confiscation in extreme scenarios as happened in the US in 1933. They recommend that clients diversify storage jurisdiction, keep some gold outside their home country in stable jurisdictions like Switzerland or Singapore, and maintain detailed records of purchases to prove legitimate ownership. This is important advice if you're accumulating significant gold holdings. Don't keep it all in one country or one storage location. Jurisdictional diversification protects you against specific country risks. Also, keep records of all your purchases with receipts and documentation. If there's ever a question about the source of your gold or taxes owed, you want to be able to prove everything was acquired legally. This is basic due diligence, but critical if gold becomes valuable enough that governments take notice. Now let me tell you what I'm personally doing based on this intelligence. I've been a gold bull for years, but this report has convinced me to significantly increase my allocation. I'm moving from about 10% in precious metals to 20% over the next few months. I'm buying physical gold and taking delivery. I'm adding to positions in major gold miners that I've held for a while. I'm initiating new positions in some mid-tier producers that have good growth profiles. And I'm allocating a small percentage to long-dated call options on GLD and on select mining stocks. I'm also sharing this information with everyone I care about because I believe this is one of the most significant investment opportunities of the decade. When a major bank is privately telling billionaires that gold is going to $5,000, that's signal, not noise. I want my family, friends, and everyone who watches this channel to have the opportunity to position themselves before the crowd figures it out. Here's what I need you to do right now. First, decide what percentage of your portfolio you're going to allocate to gold. Based on this Bank of America report, anywhere from 10 to 25% seems appropriate, depending on your conviction and risk tolerance. Second, determine how you're going to structure that allocation across physical, miners, ETFs, and potentially options. Third, start executing. Don't wait for the perfect price or the perfect moment. Start building your position now. Dollar cost average over the next few weeks if you want, but get started. Fourth, secure your gold properly. If you're buying physical, make sure you have a safe or secure storage solution. Don't tell people you have it, keep it private. Security is critical when you're holding valuable assets. Fifth, educate yourself continuously. Follow gold prices, read research, understand the drivers. This is a multi-year thesis, and you need to stay informed to manage your positions effectively. Sixth, and this is critical, share this video everywhere. Post it on social media. Send it to friends and family. This intelligence is too valuable to keep to yourself. The more people who understand what's coming and position themselves, the better. We are potentially looking at one of the largest wealth transfers in modern history as gold reprices dramatically higher. You want the people you care about to be on the right side of that transfer. Subscribe to George Vance Live right now if you haven't already. Hit that notification bell. As this gold bull market develops, I'm going to be providing ongoing analysis, updates on mining stocks, tracking the catalysts mentioned in this Bank of America report, and helping you navigate this opportunity for maximum gains. This channel is your source for the financial intelligence that the elite want to keep to themselves. Drop a comment below telling me your gold allocation and strategy. Are you buying physical? Loading up on miners? What percentage of your portfolio are you comfortable putting into gold? Let's build a community of informed investors who help each other navigate this historic opportunity. Bank of America just told their wealthiest clients that gold is going to $5,000 per ounce within the next 18 months. They've laid out a detailed, rigorous case based on debt crises, currency debasement, central bank buying, geopolitical instability, and supply constraints. They're recommending allocations of 15 to 25% to gold. They're positioning billions of dollars of client money based on this analysis. This is not speculation. This is the smart money making a massive bet, and now you know about it. The question is, what are you going to do with this information? Are you going to act decisively and position yourself for potentially life-changing gains? Or are you going to hesitate, wait, and watch gold run to $3,000, $4,000, $5,000 while you wish you'd listened? The choice is yours, but time is not on your side. Every day that passes, more of this information leaks out and more people position themselves. The early movers get the best prices and the biggest gains. This is George Vance Live, bringing you leaked intelligence from inside the highest levels of finance that could multiply your wealth if you act on it. Gold at $5,000 is coming. Bank of America has told their billionaire clients, now I'm telling you, position yourself accordingly. Stack gold, buy the miners, and prepare for one of the most significant bull markets in precious metals history. Until next time, stay informed, stay positioned, and never forget that the financial elite always see the big moves coming before the rest of the world. Now you're seeing it too. Make it count.